Welcome back, Focus Learners. Today, we're diving into another explainer, and we're going to bring some serious clarity to what, let's face it, often feels like absolute chaos on the charts. We're tossing out beginner guesswork, those random lines, and definitely the emotional trading. Instead, we're looking at a highly structured, rule-based approach. If you want to know exactly how price is delivered and where liquidity is targeted, you're in the right place.
All right, let's kick things off with a pretty harsh reality. When context is misunderstood, the market will constantly trap you. It really doesn't matter if you have a perfectly timed, beautiful-looking entry. If you're executing in the wrong market environment, well, the market's just going to run you right over.
So to fix that, here's our game plan for today. We'll start with reading market structure, then defining the trading range, explaining candle range theory, executing the perfect setup, and finally avoiding those common trading traps.
Okay, part 1. Reading market structure. Look, we've got to start with the big picture, because if you don't know what condition the market is in, everything else on your chart is literally just noise. To avoid getting caught on the wrong side, you absolutely have to understand a break of structure, or BOS. This only happens when the price definitively breaks past a major high or low. Getting this right is absolutely crucial, because these points are your main signals for a trend reversing or continuing.
Now, check out the huge difference here between a textbook uptrend and the messy reality of the actual market. In theory, it's this perfect little staircase of higher highs and higher lows. But in the real world, price action is packed with complex, choppy internal structures. Being able to spot the difference between those major external boundaries and the minor internal swings is exactly what separates the pros from the amateurs.
Which brings us to dealing with all that internal noise. Think of your major high and major low as your ultimate boundaries. As long as the price stays above that most recent major low, you can completely ignore the chop in between. Why? Because you're still in a confirmed bullish phase. All that chop is just secondary action playing out inside a larger established move.
Moving on to part 2, defining the trading range.
So how exactly do we find the current trading range where liquidity is actually forming? Let me be super clear about this. It's not just about drawing a random box around a bunch of sideways candles. A true trading range shows you the exact specific area where price delivery is active and where all those resting orders are building up.
To nail this down, we use a strict process. First, you zoom out 1 or 2 time frames. So, if you trade the 5-minute, jump up to the 15-minute or the 1 hour. Second, find a confirmed impulse leg that actually caused a structural break. And third, wait for the price to break the most recent internal swing low. That confirms the impulsive phase is actually over. And listen, the golden rule here? Never ever define your trading range on the exact same time frame you're using for your entries.
All right, part 3. Candle range theory explained.
Now, candle range theory, or CRT, is a brilliantly simple but powerful concept. It basically says that every single candlestick, whether it's on a daily chart or a 1-minute chart, is a complete trading range all on its own. CRT isn't about guessing random reversals. It's a highly structured way to see exactly how price reacts to trap liquidity at these specific boundaries.
Think about it like this. Every single candle has a candle range high and a candle range low. Since these are the absolute highest and lowest prices traded during that specific chunk of time, they act like a giant magnet for resting orders and stops. Above the high, you've got buy-side liquidity. Those are the stop losses for the short sellers. Below the low, you've got sell-side liquidity, the stops for the long buyers. Price just naturally wants to hunt those zones.
And this whole smart money concept boils down to a super simple 3-candle checklist. First, candle 1 sets the range. Then candle 2 sweeps the liquidity by poking outside that boundary. But here's the kicker. It absolutely must close back inside. Finally, candle 3 is where you look for your entry going the opposite way.
That, hey, you've got to stay disciplined here. If that second candle expands and closes definitively outside the boundary instead of just rejecting it, the setup is totally dead. The market is expanding, not sweeping liquidity. When you see that, you just walk away and wait for the next setup.
Okay, part 4. Executing the perfect setup.
Now we pull it all together. First, spot a clear overarching trend. Next, be patient and wait for a pullback into a premium or discount zone. By applying the CRT model only to counter-trend candles during that pullback, you perfectly align this micro-liquidity sweep with the larger macro trend. And once that sweep happens on your higher time frame, here's your sniper trigger. Drop straight down to the 5-minute or 15-minute chart. But don't just blindly click buy or sell. You're looking for a fair value gap, or FVG, that forms right after the sweep.
This lower time frame gap is your actual entry point, letting you get in with insane precision and keeping your stop loss safely tucked just outside the gap.
Once you're in, it's all about playing defense. You have to take partial profits at a strict 1-to-1 risk-to-reward ratio. Do that, and you lock in capital, making the rest of the trade completely risk-free. Then you just let the runner go for those major structural targets.
Finally, Part 5. Avoiding common trading traps.
Look, if you try forcing this in a choppy, sideways market with no clear impulse, you're going to get chopped up. But honestly, the most fatal mistake is jumping the gun. You literally must wait for that sweep candle to close back inside the range before you risk a single dime. And of course, if you ignore major daily support levels or try trading right into massive economic news, even a perfect setup will get wrecked. Context is everything.
At the end of the day, mastering this isn't just about reading charts. It's about having the mental discipline to literally sit on your hands until every single structural rule lines up perfectly. It's about flawless execution over and over again, not just seeing the patterns.
So when you open your charts tomorrow, I want you to ask yourself a serious question. Are you trading with actual structure, or are you just providing liquidity for someone else who is? Use this blueprint, cut through the chaos, and protect your capital. Thanks for hanging out with me for this explainer. Stay disciplined out there, and I'll catch you in the next one.